Welcome back to the Deep Dive. Today, we're really plunging into what feels like the most critical story in global finance right now. That's the AI stocks, the ones that have become the primary fuel for this whole bull market we're seeing. If you just look at the U.S. stock market, I mean, we're sitting near record highs. It's quite something. But that performance, and this is the key thing for you, the listener, the performance of your own investment portfolio is getting more and more tethered to just a handful of AI leaders, their health, their outlook. It matters enormously.
That really is the core of our mission today, isn't it? We need to get past the sort of surface-level headlines. We need to unpack the specific, tangible economic things driving this seemingly relentless climb upwards. So we're looking at massive and actually escalating infrastructure spending. That's key. Plus these big multi-year, multi-billion-dollar deals that are emerging. And of course, you can't ignore market sentiment, that volatile power. But I think most importantly, we have to really scrutinize the risks, especially this growing circularity within the AI ecosystem. It's concerning.
The scale is just immense. I mean, this isn't some small peripheral sector anymore. You look at the S&P 500's top performers this year. Most of them are directly, inextricably linked to AI. The sheer size of it means this isn't just a market rally. It really is the dominant narrative right now. So let's start right at the center, the command center, if you will. The Magnificent Seven, the Mag 7. We've all seen the incredible, frankly, staggering growth, but their influence on the rest of the market.
Yeah.
It's becoming almost disproportionate, wouldn't you say?
Oh, absolutely. It's genuinely historic. Our sources are highlighting that the Mag 7 stocks now account for, get this, 1/3, a full third of the S&P 500's market cap.
Wow, 1/3.
Yeah. Just think about the mechanics of that. It means a third of the whole market's movement is basically dictated by just 7 companies, and their valuations are increasingly tied almost solely to this AI narrative. You know, when analysts dig into the valuation sentiment for these specific companies, they see something pretty unique. Wall Street seems to treat these shares like a, quote, daily referendum on whether AI is considered hype or reality.
A daily referendum.
That's intense.
It is.
Yeah.
We aren't just priced for maybe a strong quarter ahead. No, they're priced as if AI is the fundamental perpetual growth engine for years, maybe decades to come.
And you can see that aggressive feeling, that sentiment, filtering down the supply chain too, right? Which suggests it's not just those top 7 winners. Well, the Mag 7 definitely set the pace. Look at the companies orbiting them. Data storage giants, for example, like Seagate, STX, and Western Digital WDC. These are the companies providing the actual physical memory for all these new data centers. And their stocks have nearly tripled this year alone. Tripled. Then you look at the software side. The firms actually trying to commercialize AI. You've got Palantir, PLTR, AppLovin, APP. Both have more than doubled.
Yeah, and it's significant.
It really shows investors believe the whole chain, the physical build-out and the eventual applications will lead to just monumental profits down the line. And that momentum, that supply chain performance, it really reinforces the core belief that the demand must be real. It's not just hype. It's actually a pretty compelling argument, right? If the suppliers of the physical gear are doing that well, then surely the massive spending by the hyperscalers must be grounded in some kind of reality, not just, vaporware.
Okay, right. So let's unpack that. What is the actual concrete fuel keeping this confidence so high? Because it isn't just an idea floating around. It's massive infrastructure investment. We're talking capital expenditures, CapEx, on a scale that tech world really hasn't seen in, decades.
That's exactly it. And the primary source, the main tap for this financial flood, it's the big 4 hyperscalers: Microsoft, Alphabet, Google's parent, Amazon, and Meta. They are the ones writing these huge multi-billion-dollar checks. They have to build the necessary AI infrastructure, the specialized data centers, the advanced cooling systems, the network capacity, all of it.
And that spending, it has this immediate, almost explosive effect on the manufacturing side, doesn't it? It's caused revenues to chip makers, NVIDIA, obviously, but also Broadcom, Micron, to, as the sources say, explode.
Explode is the word.
And this activity just constantly reinforces that market story, that narrative that AI demand is somehow insatiable. The thinking seems to be, look, if the handful of richest companies on Earth are spending this heavily just to build the foundation, then the actual end demand must be even bigger, maybe exponentially bigger than we can even grasp right now.
To try and put a number on that, Citi analysts just updated their estimate for how much just the hyperscalers, and they include Oracle and CoreWeave in this group too, will spend on infrastructure. Their new estimate is $490 billion.
Almost $500 billion.
Almost $500 billion. Just think about that commitment.
Yeah.
To spend that kind of money building out capacity, It's truly unprecedented. And that money, it has to flow somewhere, right? And right now, a lot of it feels like it's flowing straight through the stock market valuations.
Okay, $490 billion is staggering. But what makes this spending spree sustainable? Is there more to it? Because there's also a policy factor here that seems to be, well, turbocharging things. We should probably talk about the tax changes, the ones recently codified, letting companies immediately write off these huge infrastructure investments.
Yes, that's a really important piece of the puzzle. The key mechanism is that immediate write-off. See, previously, big capital expenses like this had to be depreciated, spread out over several years for tax purposes. But now, if you let companies immediately deduct 100% of these massive infrastructure costs in the very same year they spend the money, well, the financial incentive becomes enormous.
Okay, but how does that directly translate into, say, stock performance? What's the connection?
Well, it's about cash flow. Immediate write-offs significantly boost free cash flow dramatically. So if you suddenly have all this capital, freed up cash that otherwise would have gone to taxes, what do you do with it?
You invest more.
Exactly. You have more capital ready to be plowed right back into CapEx, specifically into building more AI infrastructure. It feeds itself. Companies have had some time now to sort of factor this new law into their financial planning, and we're kind of expecting to see the results soon. The hyperscalers are due to update investors on their CapEx plans in late October, early November. Alphabet and Meta have already lifted their forecasts, remember. So if we see any unexpected increase in spending guidance from Microsoft or Amazon, Wall Street is going to see that as direct proof that this tax policy mechanism is working, and it's just going to reinforce all the bullishness out there.
Okay, this is where, for me, it gets really interesting, and also where the risk profile seems to, I don't know, fundamentally shift. Because the drivers of the rally seem to be evolving. It's not just internal CapEx anymore, like Microsoft spending money to build things for Microsoft. Now we're seeing more and more of this. Circularity, is that the right word?
That's exactly the term people are using, circularity.
Where AI companies are investing in each other, often setting the investments specifically so they can buy goods and services from each other, it feels different. Let's maybe walk through a specific example, because this one seems pretty radical. It involves the biggest names, NVIDIA and OpenAI. The sources we looked at reveal this commitment where OpenAI says it will deploy 10 gigawatts of NVIDIA systems. Huge amount. But wait, here's the twist. In return, NVIDIA will reportedly invest $100 billion in OpenAI.
Okay, hold on. Let me make sure I understand that. You're raising the exact right question here. This needs sharp analysis. Are you saying NVIDIA, one of the biggest hardware vendors, is essentially subsidizing maybe $100 billion worth of capacity for OpenAI, one of its key customers?
That is precisely what the deal structure looks like, based on the reporting. NVIDIA, the chip maker, invests billions in its customer, OpenAI, which effectively, it subsidizes OpenAI's infrastructure costs and presumably ensures OpenAI stays locked into buying NVIDIA's hardware for the long haul.
Wow.
It locks in the customer, guarantees massive future revenue for the vendor. It seems like smart business on one level, but also intricate.
And is that the only example? Or are there others?
No, that's not even the end of it for OpenAI. They also committed to spending, this number is just enormous, $300 billion on Oracle's cloud computing services over the next 5 years.
The $300 billion on Oracle Cloud.
$300 billion. So what this reveals is this, like web, a highly interconnected, mutually dependent set of multi-year commitments. And these commitments are now baked into the forward-looking revenue guidance for multiple massive companies.
Okay, this creates, a truly unique and frankly fragile risk profile, doesn't it? Because while these massive deals, they look incredibly solid on paper, right? They feel tremendous investor confidence. I mean, who wouldn't? Like $300 billion in guaranteed revenue.
Sounds great on an earnings call.
Exactly. But it creates this circular ecosystem, as you said. And that circularity means the vulnerability gets compounded. Think about it. If OpenAI just hypothetically hits some serious technical or business roadblock, well, that failure doesn't just hurt OpenAI. It instantly craters the guaranteed revenue streams that NVIDIA and Oracle were counting on, that they told investors about. None of these deals are truly guaranteed, not in the real world. And if the overall business environment shifts or AI development slows, well, the music might just have to stop for a while.
Which brings us squarely then to the elephant in the room, the constant nagging concern about an AI bubble. This rally, despite its strength, continuously faces that risk that sentiment could just sour, turn on a dime. And we've actually seen moments where investors could have panicked, right? But somehow they just shook it off and kept buying.
So far, yes. The big tech companies have managed somehow to show just enough proven benefit from AI or maybe just enough compelling future promise to keep Wall Street comfortable with these incredibly aggressive, interconnected spending plans. But you are absolutely right. The margin for error feels razor thin sometimes. You get the sense that the entire market is always, quote, one earnings cycle away from a negative interpretation, an interpretation that could trigger a pretty significant correction.
We saw a couple of big shocks, potential shocks anyway, earlier this year that felt like they should have been devastating for this narrative. Remember back in January, investors learned about that Chinese startup, DeepSeek. They showed off a super efficient reasoning model. And the immediate fear was, hang on, if AI models can suddenly become radically more efficient, why is Silicon Valley spending billions building out capacity that might be obsolete really quickly?
Right, the efficiency shock. That was
Yeah.
a wobble.
And that was followed over the summer by that pretty sobering piece of research from MIT. They found that 95% of corporate generative AI pilot projects, the internal experiments companies are running, had failed to deliver any material return on investment, any ROI at all.
Oof. That statistic should have been a massive red flag, shouldn't it? If only 5% of these internal projects are actually delivering value, how on earth do we justify the $500 billion spending spree based on future ROI?
Exactly. Yet despite these shocks, the money just continues to pile in. The valuation stays sky high. So what does it all mean? How resilient is this rally compared to, say, past tech booms that went bust?
That really is the critical question, isn't it? And when you compare this current AI boom to, say, the disastrous fiber optic build-out back in 1999-2000, there is one crucial, absolutely fundamental difference in the financial structure.
Okay, what's that?
Debt. That late 90s boom was heavily, dangerously financed by high-yield debt. Junk bonds, essentially. Companies were borrowing huge sums of money to fund incredibly speculative infrastructure builds. Today's AI build-out is, well, it's not fundamentally being financed by debt, not in the same way at all. The companies funding this near $500 billion effort, the Mag 7, the other hyperscalers they have, and this is key, the biggest businesses, healthiest balance sheets, and deepest pockets on Earth.
So their existing financial health acts as a kind of massive shock absorber. Is that the idea?
That's exactly the idea. They're hugely profitable non-AI businesses, whether it's cloud computing, digital advertising, e-commerce, enterprise software. They generate immense reliable cash flow. So if sentiment suddenly shifts, or if that ROI from AI remains elusive for a few more years, these companies have the underlying financial strength to absorb the failure of one of these circular deals or just a general slowing of AI growth. They can continue funding their AI ambitions without facing bankruptcy, which is exactly what happened to so many debt-laden telecom and fiber firms back in 2001. That underlying financial resilience, I think, is the main reason investors are still comfortable making this very long-term, very expensive bet on AI. So if we try to synthesize everything we've talked about, it seems clear that the performance of the entire stock market right now, not just the tech sector, is currently dependent on this continuation of massive capex spending that's reinforced by favorable tax policy and sustained by the positive sentiment that lifts all these AI and related tech stocks. If that spending slows down for any reason, the market rally almost certainly slows down with it. They're tightly linked.
That is the perfect summary, I think. And it really leaves us with one final, maybe provocative thought for you, the listener, to consider. Given this commitment, this estimated $490 billion in capex, and these huge circular internal deals we discussed, like that $300 billion OpenAI commitment to Oracle, we really have to ask ourselves, how much of the current bullishness, the high valuations, is driven by genuine, proven AI revenue? By that, I mean money clearly generated from external profitable AI products sold to actual customers outside this core ecosystem of builders. And how much of the market's current performance is actually being driven by the internal investments, the subsidies, the circular deals that are required simply to build the foundation of AI in the first place. It raises a really important question about where the true, sustainable, independent revenue driver really resides right now, and maybe how long the builders can keep propping up the whole structure before the actual applications truly start paying for themselves on a massive scale. Something to think about.